Got some fives. We do a little bit better. So, gentleman right here says 650. That's very close. Last year, Experian run something called the State of Credit every year. It was just floating around 660. Hi, Jose.
Hi, how's it going?
You guys notice what Jose's wearing?
Tie.
Sorry, we're right over there. They take 660-ish, right? So that's average. To get into these programs with Chase or with any large financial institution, any idea where the credit score needs to be? You say that jokingly, but it's if you go into the mainstream mortgage market, 700s and above is the norm. We all have specialized programs for first-time home buyers as part of our community reinvestment obligations to the federal government. Those start at 620 as the entry into most of these programs with a 620 credit score. When we pull your credit, any financial institution, this isn't just Chase, we'll categorize you into 3 different categories, okay? We pull that credit report, it's either a no-hit, a thin file, or a thick file. And I mentioned that because, well, I'll get to the second part. No hit. Any idea what no hit means? If I pull your credit report, no credit score came up. Why do you think that is? Normally because you're using a lot of cash transactions, you haven't applied for a credit card, you haven't had an auto loan, or you don't have anything active recently. Anything you had, you paid off long ago, and there's nothing active in the last 6 months. You may not generate a credit score. A thin file, on the other hand, 2 accounts or less. You may have 2 credit cards, a credit card and an auto loan, maybe a couple of student loans. We call that a thin file. A thick file means that it's more than 2 accounts, and there's history there that you can see, and they have at least 2 years on it. What do you think as a bank, where do we want you guys to be? A thick file, right? We want to see history, we want to see your payment patterns. But guess what? If you don't have that, it's not the end of the world. A lot of these programs, and this is something I want to talk about with Chase's program that we just reincorporated, is something called non-traditional credit. So what non-traditional means, I'll try to explain it very concisely. We have an education component later, so I won't go too deep into some of this stuff. But non-traditional essentially means that you had a thin file when we pulled your report. On a credit report, we have credit cards. What else? You guys know what's on the credit report? Auto loans. If you haven't paid stuff, they'll show up in a different section. There's your judgments, liens, student debt, right? And mortgages, since we're first-time home buyers, we don't have a mortgage on there. But there are other financial responsibilities in our lives that we have, that we commit to, that we pay on a monthly basis. Like what? Cell phone rent, cell phones, utility bills. We can use that to create a credit composite, work with your individual credit providers, cell phone companies, different things, to put together a credit file to be able to move forward with your mortgage transaction. That's called non-traditional credit. Just know that that's an option if you fall into that category. Does that make sense? Yeah, okay. Just 2 more things I wanted to talk to you about. One thing, again, I'm talking about Chase, but I'm talking broader also. Something in the banking industry that a lot of us require are called reserves, and sometimes homeowners aren't ready for that. We can do 100% transaction oftentimes. Chase, we go to 105% CL, combined loan to value, and we'll discuss what that means in a little bit. Meaning you could potentially do this with no or very low down payment. Then what else is there? Closing costs. In addition to that, there's something called reserves. So a lot of times, depending on your credit situation, we might require 2 months of mortgage payments, what we call principal, interest, taxes, and insurance, PITI. All of those payments sitting in a bank account after the whole transaction is said and done. That's a little emergency buffer sitting there that makes the banks feel comfortable to close the transaction. Once the transaction is closed, it's your money, you do whatever you want with it. So with Chase, depending on your situation, we may need a couple of months reserve, but Jose's here, he'll talk to you more about that individually. And the last thing, just when you're talking about these kind of transactions, FHA, 100% financing, just be aware that the loans may have mortgage insurance. It's going to happen in one of 3 ways. In FHA, when you close your loan, they'll charge you a upfront premium on your mortgage loan, and then you pay a monthly premium. With banks like Chase, we've negotiated a discount insurance premium. It's much lower than what you pay on FHA, but you'll see it on your statement as a separate line item, and it's through a private mortgage insurance company. A third way is that it might be built into your rate. So you might pay a slightly higher rate because the financial institution has worked it that way. Just be mindful that this insurance, who does this insurance protect? You guys? It protects us. Right? This isn't your hazard insurance. It's not the insurance you pay in case of a fire or any kind of hazard to the home. This insurance protects the bank. So I think I've probably taken up in.